Okay, let's talk about one of the biggest stories happening in finance right now, crypto regulation. It's a huge deal, and believe it or not, a new rulebook coming out of Dubai might just be the blueprint the whole world has been waiting for. So let's dive in and break down exactly what's going on, and more importantly, why you should care. It really all comes down to this one question. For years, crypto has had this reputation, right? It's the Wild West, full of massive opportunities for sure, but also just packed with chaos and risk. The real question is, are we finally seeing the sheriffs ride into town? And look, we all know why this conversation is happening right now. When giants like FTX came crashing down, it wasn't just another dip in the market. No, this was a massive, blaring wake-up call for everyone. It just laid bare how incredibly fragile the whole system was without any real guardrails in place. The dangers became so painfully obvious. You had these insane price swings, regular everyday investors losing their life savings, and of course, the big financial players, the institutional money, just sitting on the sidelines, totally unwilling to jump in because they simply couldn't trust the market. This is the chaos that regulators are now trying to clean up. So, enter the main character in our story. Dubai's Virtual Assets Regulatory Authority, or VARA for short. They've looked at the chaos and decided, okay, enough is enough. They're stepping in to write the rule book that this industry has been so desperately missing. Now, their mission is pretty simple, but it's also incredibly ambitious. They want to transform crypto from what feels like a high-risk casino into a transparent and secure ecosystem. And let's be clear, they're not trying to kill crypto, it's the opposite. They're trying to help it finally grow up. So, who exactly are these rules for? Well, they're aimed at what the industry calls VASPs, which stands for Virtual Asset Service Providers. Basically, think of your crypto exchanges, your digital wallet providers. If you're a business in Dubai handling digital assets, these new rules are aimed squarely at you. All right, so what are they actually doing? How does this new rulebook really create a safer market for everyone? Let's get into the nitty-gritty of their plan. VARA's whole approach really rests on 5 key pillars. First, strict client assessment, making sure traders actually know what they're getting into with high-risk products. Second, tighter financial controls, keeping an eye on things like leverage. Third, and this one is absolutely huge, mandatory asset segregation, basically keeping customer money separate from company money. Fourth, high transparency standards, no more hidden risks or fees. And finally, giving regulators the power to intervene when things go wrong. Now, let's zoom in on that third point because it's a direct shot at one of crypto's biggest disasters. This right here is the big one. This single rule is a direct answer to the FTX catastrophe, where customer funds got all mixed up with the company's own cash. VARA is making that flat out illegal. So the bottom line is, your assets are your assets, period. They can't be touched. It's a concept that we totally take for granted in normal banking. Your bank can't just dip into your savings account to pay its electricity bill, right? VARA is just applying that same fundamental common sense principle of security to the crypto world. Okay, so those are the rules. But what's the actual impact going to be? What are the ripple effects here? Let's take a look at how this could build a much stronger foundation for the entire industry. This really shows the transformation perfectly. We're talking about a shift from a market that was driven by fear and insane risk to one that's actually built on confidence and safety. And that change, that's exactly what's needed to bring the serious, long-term players into the game. The goals here are crystal clear. By making the market more stable and by protecting everyday users, VARA is really going after the ultimate prize, getting huge institutional investors, we're talking pension funds, investment banks, to finally feel safe enough to come into the crypto space. And really, that's the bottom line. This isn't just about making rules for the sake of making rules. It's a calculated, strategic move to build the kind of trust you need to attract the trillions of dollars in institutional capital that have just been sitting on the sidelines waiting for a safe way in. So, does that mean Dubai's model is the perfect blueprint for the future? Well, like any big, meaningful change, it comes with some really important trade-offs you have to consider. This table really lays it all out. And while most of this is super positive, you see better credibility, way more security, what's really fascinating is that third line. Trading freedom is rated moderately negative. VARA is being upfront about it. These rules will restrict some of that high-risk, high-leverage trading that really defined the whole Wild West era. And that is the core trade-off, isn't it? You give up a little bit of that chaotic, anything-goes freedom in exchange for a market that is healthier, more sustainable, and a heck of a lot less likely to just implode. It's the kind of trade you have to make to attract those big pension funds and endowments that need stability before they can even think about investing. This quote just says it all, really. The whole argument is that regulation isn't about holding crypto back. It's actually the very thing it needs to get the legitimacy and the stability required to finally go mainstream. Which leaves us with the big, final question. Dubai has put a clear, comprehensive blueprint on the table, and right now, the rest of the world is watching. Will other major financial centers follow their lead? And are we really truly seeing the end of crypto's Wild West for good? I guess only time will tell.